If you look at the core economy, our team has a mild recession predicted in the middle of 2023, and then coming back out of it later in 2023. So look, things like the rail strike or the war in Ukraine and what happens in China with shutdowns, those are all sort of things that can really derail the economy, and everybody knows that, and we've been dealing with them for quite a period of time. But if you look at the core economy, our team has a mild recession predicted in the middle of 2023, and then coming back out of it later in 2023. Now, that was predicted to happen earlier this year. There was going to be a real slowdown, the Fed was going to raise rates, and it's all pushed out largely because of one thing, which is the U.S. consumer, who is spending money, and we just got our spending from Thanksgiving to last Saturday, and it was up 3% over last year, which was up 23% over the year before, 20% over where it was in 19. You see booking travel and things like that. You see the consumers employed. You see them spending money. You see them having money in their accounts. Now that means inflation has to be tackled by the Fed, but the consumer actually is both a buffer against that and also makes it difficult. At the end of the day, the belief was if any of those horribles came together, you could have really a different outcome than the Fed tightening. And the Fed is tightening in an unprecedented way because we have an unprecedented inflation, 40, 50 year long inflation. So where does that affect first? Housing. Obviously that's changed dramatically. But rent increases are only coming through now. So in the end of the day, the consumer is held in well, and in the end of the day, the consumer stays reasonably strong because they're employed.
So I'm hearing no economic hurricane from Brian Moynihan, am I right?
A mild recession.
A mild recession. When is it going to get better for housing for Americans?
Well, so this is the toughest thing because you have to slow down the economy, you have to slow down inflation, and the way you do that's raising interest rates.
The Fed wants us to buy fewer homes.
That's exactly right. And so what is the intended outcome of their policies doesn't feel good when you're trying to buy a home, if you're a young family trying to buy your first home, whatever. So that'll straighten out. Now you have to sort housing into two pieces. One is the people who have mortgages that are outstanding, locked in below 5%, 4%, 3%, 90% below 5%. 80% below 4, 50% below 3. They're locked in for 30 years.
Yeah, but other folks.
But when you go to buy a house, you're feeling that effect. And that's slowed down dramatically, and that's why the home builders and others. But that's the intended outcome. What will happen is as we see inflation slow down, and you're seeing the rate of growth of inflation slow down, still inflation, you'll see rates come back down to more the target rate, and you'll see the adjustments come through. And that'll happen. That'll take almost 2 years.
2 years of pain for people trying to rent or buy a house.
2 years of slower activity. Now the rental side of that is the key, and that's the rents have increased, and you're seeing rents have increased and already starting to decrease in some cities around the country. But that's where you have to be more concerned because half the people in America pay rent. They don't own their home, and that is where it's affected. That's still ahead of us.
And millions of them have a lot of outstanding credit card debt. And can you just help us understand why credit card interest rates are at a record high? Now, I understand the Fed's raising rates, but the Fed funds target rate compared to APR seems extreme. And I know there's not collateral to back credit cards, but do they really need to be that high?
Well, the reality is a third of our credit cards pay off every month. They don't even pay interest, right? So we give you the money for 30 days later, 45 days later, you pay us.
2/3 of Americans don't.
And then the ones that do, the rate structure is far lower than the stated rate structure just because of all the different things that have gone on. So look, those rates adjust with the market. They'll come back down with the market. They were low for a long time. But the reality is that the good news is for America is the delinquencies on credit cards are low. They are much lower than they were in 19, which is very good credit times for banking system. So our job is to actually help our customers continue to prosper and live. And the key thing is, remember, unemployment's at 3.6, mid-3s.
Right.
The worst projections to get to 5s were where it was, in the 17, 18 range.
What is happening with the American worker?
Well, the labor market's got very tight, so the dynamics shifted that with the kind of employment levels we had, the claims for unemployment still are bumping along at very low levels, levels that haven't been seen since the numbers of workers are 25% lower. So, the labor market's very tight, and so the negotiation power moves around, right? I mean, that's what happens. The quit rates got way high. What you're seeing that now is mitigate, which is actually good from the Fed perspective in terms of the economy, but you're seeing that mitigate. Now, how do we think about that?
Yeah.
Our job is to provide an ability for an 18-year-old to join our company and to be here their entire career and get themselves educated and trained with us. And you do that all day. I just celebrated a 50, 55, 60, 65, and a 75-year employee the other day. So think of 75, do some math and think that the person started as 18 and went to college. That's what great employers do. And so our turnover rate moved up like everybody else has already moved back down. My guess is by early next year, we'll be back in line where it was in 19, which is good. But that takes employers really saying, how do I holistically help a person develop a career?
Like you guys gave money, a lot of it to employees to pay for childcare during the pandemic when you asked them to come back. Collapsing. What went wrong with crypto?
What went wrong is I think it was a speculative asset got very high and then came crashing down and the leverage embedded and all that happened. But that was relatively predictable, and many of us said be cautious here. The good news is, as you think about the history of it, the rate of movement out of our accounts into crypto has slowed way down, which means investors have
a lot of people got fleeced, and you guys are so highly regulated.
Yeah.
I mean, watch any of those, and your testimony before Congress. Where are the regulators on this? Is it safe for anyone to have a crypto market that exists anymore without regulation?
Well, you would have to back up two things. Blockchain, the technology, very good. We have hundreds of patents on it, literally.
Sure.
The idea of
the
idea of a currency and stuff, it's not needed. We can transact in ways that are wonderfully fast. The real-time payment system that are connecting around the world. The Fed is building one. We've already built one in the industry. The ability to send money to anywhere in the banking system. These things are important. So, are there areas where the industry has to lead in that other entrepreneurs saw an opportunity? Yes, the small balance, a cross-border payment, and we're working on